Welcome to the Wheelbarrow Profits Podcast, where you get multifamily investing made real. Learn from top players in the real estate investment world as they share their secrets with you and discover proven strategies on apartment investing that actually work. To learn more about Wheelbarrow Profits, visit jakeandgino.com, your one-stop shop for everything multifamily. Now to your hosts, Jake and Gino.
Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, I'm doing good today. We're slowing it down today. Someone from Arizona is on the line with us. It's going to be an amazing call.
South, man. Come on, you're killing him over here. So we have a special guest today. Today's guest is Ken McElroy. Ken is the best-selling author of the ABCs of Real Estate Investing. Many of you may know him as a real estate advisor to Robert Kiyosaki of the Rich Dad Company. Ken has experienced massive success in real estate and has been involved in investments totaling over $700 million. So without further ado, Ken, welcome to the show.
Hey, thanks, guys. Great to be on.
Ken, how you doing?
Awesome.
Hey, great to have you here. Tell us a little bit how you got started in real estate. Me personally, I had a corporate background, and Gino had a restaurant background. We made the flip, years ago. What was your story like, and how did you get into it?
I was actually very lucky. I was not out of university yet. My senior year, my buddy called me up and said, hey, you want to manage this property downtown Seattle? It's free rent. And I'm like, free rent to a college student? That's awesome. So I literally moved in, had no experience, started collecting rent, started doing maintenance because I grew up, my dad was a contractor, so I could do all that. I was soon cleaning toilets and painting units and renting units and all that. And as I was finishing school, and then the owner of the property would come every month and collect the rent and then go to the bank. And I'm like, okay, like I'm on the wrong side of this desk. I swear it was that clear to me. And but the property management company, which was based up in Seattle, I looked into them and I actually ended up working for them in the property management division. At the time the company was small. Now it's very, very large. I think they have 250,000 apartments. And it's called Pinnacle, and they're based out of Seattle. And so the founder of that was John Goodman. He was just starting his company at the time. We just had 2,000 or 3,000 units, and so the only job I ever had for the first 10 years was managing apartments and all up and down the Western United States. And what an education! And that's actually what gave me the confidence and to be able to buy them, because we would take over properties. This is what I would tell people: you take over a building. The property management world is very, very hard, as you know. So if you take one over, let's say from a client, and the operations go down, you get fired. If you take it over and it stays the same, you get fired. If you take it over and improve it, they sell it and you get fired. So, I mean, literally, you're always working your way out of a job. But honestly, I think I managed somewhere around 25,000 apartments all up and down the Western U.S. And so by the time I actually was in a position to be able to start looking at buying them myself, I felt pretty good about knowing how they would run. And so that's basically how I started.
I've got so many questions here. The first one is, what did you go to school for? And number two, what did your dad say when you went to property management?
Yeah, I know. So I had a wrestling scholarship. So thankfully, because neither of my parents went to college. I'd studied business at Pacific Lutheran University in Tacoma, Washington.
Oh, okay.
And my dad, mom, I think they were just happy to, that I had a paycheck coming in. You know what I mean? So,
he's not in jail.
Yeah, exactly. Right. Yeah.
So how long was it that you felt comfortable once you said to yourself like that I guess that inflection point where you felt comfortable enough to start buying for yourself?
It was a process for me. I think I wasn't exposed to any of this when I was in college. Certainly after I started being exposed to it, and you start to see deals come together and the way that they're bought and the clients and who they are. And it was really neat to be on the inside, to be able to see how the deals were put together the financial packages and send them out with checks, hopefully, or if not, be able to explain it away and all that stuff. So it was a great, great way for me to learn the business. And it probably took me about 6 or 7 years before I felt comfortable. And that's when I got into my first partnership and moved to Scottsdale, Arizona.
What is your favorite part? Before we get into your first deal, what's the favorite part of the business for you? Is it the property management? Is it the underwriting? Is it the acquisitions? What do you like best about the business?
Well, I really like the property management piece because it's I rarely see things that I haven't seen yet. Even though I actually look for those things because I'm always trying to learn, but I've walked hundreds of thousands of units and seen quite a bit. But I actually right now, I think I really thoroughly enjoy the acquisition process. I like going into towns and meeting with the brokers and looking at deals and seeing the potential and increasing the value of neighborhoods and raising the standard of living for a market through good capital injection, because that's been our model. Our model has been to go and find stuff that's maybe tired 80s, 90s, and put quite a bit of money into them right at the beginning.
Ken, you own your own property management company, correct?
Yes.
So do you recommend people using third-party management, or is there something to having your own property management company that you say, this is where I want to be?
Well, so my very first investment was a 2-bedroom, 2-bath condo, but I had the advantage of being in management. So for me, starting a management company, this is my fourth one, we have 350 employees, and it's really a very natural thing. There's a lot of, to answer your question directly, I think that you're better off to hire a company initially and learn from them and even start your own later, and learn as many things as you can, because there's a lot of complex small little things that take risk out of day-to-day operations that a management company does for you that are really common sense, but people don't do.
Well, Jake, we sort of screwed up. We did it the opposite sort of way, because we bought our first 25 unit, and I guess I had management experience, but more of the triplexes, strip malls, that kind of stuff. And I don't say we winged it, but we did a lot of research and a lot of stuff in the front end, and we just took our lumps in the 25 unit, and we had a resident manager. Then we went to the 36. We scaled up. So I mean, there's merits to both strategies. But I think it's just in whatever situation the person's in. If it's in your backyard, it's a lot easier to manage. I couldn't manage anything in New York because it wasn't my backyard. So, I like that, taking the risk out by getting a management company. How do you find these management companies? A lot of guys come up to us and say, where do we find a competent management company?
Yeah, it's a good question. So when we started buying in Oklahoma, we hired a company there, and then when I expanded to Texas, I actually bought a company, a 9,000 unit management company there, and then I've started a bunch myself over the years. But I think that my experience looking from the inside out, there's always that guy or that gal who's credible in a market, and her or his name gets mentioned all the time. And I don't care if they're an ABC company or DEF. It doesn't really matter. The systems generally at the management companies are all the same. And I think that the companies that find the best people and keep the best people and retain the best people and have the lowest turnover are typically the best management companies that I've seen. And that's been my experience.
Mm-hmm. What was your first size complex? How big was the first complex you bought?
Well, I bought a bunch of small stuff. I still own a bunch of small stuff, but then I made a big jump to 182 unit in Sun City, Arizona, which I still own. I actually bought it from Leonard Litwin of Glenwood out of New York,
Is that in your book? Is that the complex that you write in your book? Yeah.
And so, that was my first one. We bought it. It was $9 million, and
I remember that.
Now we just had it appraised. It's, in the mid 20s, but that was, 15 years ago, but that was my very first one. And he made it really easy on me. It was basically a handshake, and it could not have gone any better for me. He gave me the time to go out and get financing. He gave me the time to go out and raise the money. And, and I was already managing the property for him. And so that part was really, really simple.
You guys got to go out there. Everyone listening to the podcast, read the book, because that $9 million purchase had so many value adds. You put a bus service in, getting busing guys. You had apartments that were downstairs you started charging a premium as opposed to the ones upstairs. I remember all the value adds you had on that property. And I think it was worth $12 million after you were done within 6 to 12 months, correct? You went out and refied that thing.
Yeah, that's exactly right. Yeah. And so that's a classic example of a building that we bought for $9 million. It's worth somewhere in the 20s. I think we have about 16 or 17 million of debt on it, and we've refinanced it 4 times, all tax free. Yeah. So each time get our money back.
How did you make that shift in your, mind shift, going from that small stuff to that 182 units? Because Jake and I, like I said, we had the progression. We had a small 25, then a 36, then we went to 136. So we were already had a couple small ones. But how did you make that mind shift where, wow, $9 million? That's a big number.
Yeah. And honestly, that was for me the biggest obstacle. I think most obstacles are in your own mind, and so I just surrounded myself with people. I'd been on the other side of the table, so I'd been the management company that had been taken over by a new buyer, and we'd also been the management company that had been taking over the property for a new buyer. And so I'd been in that scenario enough and met with the lenders enough, and we have lender inspections and all those things, and so my network was growing as a management company. And so when I actually what I found was I couldn't actually believe how easy it was when the numbers are all what they are. I mean, I didn't realize how thirsty the banks were to invest in debt, and honestly how some of these high net worth people were looking to invest because of tax breaks and stuff. So it was kind of an eye opener. I think that everybody believes that they have to have all the money in the bank, and they have to have the people lined up for them to be able to buy. But the truth is, if it's a really good deal, it funds very quickly.
I agree with that. Before we get into the market specific and all that, how do you locate deals? I mean, you were fortunate enough to have a property management company, but a new guy getting into the market, deal flow right now is difficult. And, I always say broker relationships, but do you have any other tips on locating deals in a specific market?
Yeah. So, I think we probably go about it a lot, very, pragmatic, where I'm trying to find, as Gretzky says, where's the puck going, right? He's like, why did you score so many goals? He's like, well, I always skated to where I thought the puck was going. And so that's what we tried to do when we went to Texas after the boom. If you took a look there, they had a very soft landing. They were very pro-business. There were areas that were decimated, don't get me wrong, and like Arlington and South Dallas, but North Dallas was really, really very, very, very vibrant. Frisco, Plano, Carrollton, and Richardson, some of those markets. And they were still very much in the path of growth. And I think that you have to go to those markets, you have to read everything, and you have to see kind of what's happening. But for us, where we always looked at what we would call permanent job growth, and there were businesses expanding back in the mid 2000s and kind of during the recession. Not a ton, but there were, and so that's what we started with. Obviously oil was big back then, but we focused on healthcare, we focused on insurance services and things like that. That's why we went to San Antonio, and that's why we were in Austin. IT, and so we ended up being generally very right in a lot of those markets and going in going in early. And so on the other side of it, though, you got to look for markets that are, deflating. Markets that are deflating, like Phoenix was deflating because of the, it was propped up temporarily by construction. So you have all this construction labor, and it's flowing through the economy, and it looks to be very, very healthy. But the minute the banks stopped lending, then all of a sudden, all that was gone. And it wasn't sustainable. So for us, it's really job growth and population growth kind of lead everything, and then from there, there's all the idiosyncrasies in the markets too, right?
That's why I love your book, because you go back and you talk about markets like Vegas, you talk about Oklahoma City. Now guys are all in those markets now, but you've been talking about them 10, 15 years ago. And I was like, that is an amazing way to analyze a market. What markets do you like now? What cities pop up on your radar right now?
Well, for us, anything that's job-based. And so, we've been looking in Portland, Seattle, Salt Lake City, Phoenix. We really like Phoenix. Obviously, it's where we're based. And we're not really looking right now in Texas anymore. In fact, we actually just sold a building in Austin, which, we never hardly ever sell. And so what we're doing right now is we're kind of, as we grew, we actually have closer to $1 billion now of assets, about 10,000 units. And but, I think that's 40 or 45 projects. Of the 45 projects, there's, 5 or 6 that are, tough, right? You're always talking about them. How do we get the occupancies up? Maybe we bought them wrong. Maybe we bought the wrong location, whatever. You're just not going to nail it all the time. And so we're actually selling some of those back into the market. And, because the markets are so hot, you owe it to your investor to capitalize on these crazy prices and get out of some of these projects that are, could be problematic.
Why did you sell that deal in Texas? Was it just the right time? You got a great number for it, made depreciation, saw another opportunity? Yeah.
So I was through a boom and bust in Austin in 2005, and there's like 12,000 units being built in that area. It's kind of near downtown. And so we had basically, the price was doubled, and our investors were out of Canada, and they had invested when the dollar was actually par with the U.S. dollar, and now it's like 40% different. So we had double the price plus 40% on their money, and so we're sitting down there, and they came down and they said, what do you think? I said, I hate to sell it, but I think it's probably a good idea.
They're loving Ken right now, that's for sure.
Yeah. So, but that actually would have been a great asset to hold through the cycle, but it's just, sometimes investors, circumstances are change.
How are you underwriting now in this current market? I mean, it seems like we're at the top. I mean, guys were underwriting 3 to 5 years with an IRR of 18 to 20% just a couple of years ago, and now it seems like I see guys underwriting at 12 to 14 IRR, and they're given 6% preferred returns. I mean, what are you shooting for in this current climate?
Yeah. So, I think the biggest issue facing us are exit cap rates. I actually think that's the biggest issue. Yeah. So let's say we buy at 5. Let's say it's very unlikely that you're going to sell at 5. So you have to look at that. That's a big number when you go from 5 to 6. And so doesn't really matter what you do. You can have 8 to 10% rent growth for 4 or 5 years and have an exit cap rate higher and lose it all. So I think that's probably the biggest issue facing us right now. And as you underwrite and as you put packages out and as you're doing stuff with your lenders, they're not going to let you put an exit cap rate higher. But I believe that it will be, just in looking at cap rates. So that's part of the reason we backed off. But we try to underwrite everything the way that we, obviously, we're really not different than anybody else, where we're trying to buy the property for how it's operating today, period. And the seller's trying to buy it for, where we're going to take it, or sell it, for what we're going to take it. And so it's just a matter of getting it to our number. And so when we started getting further and further and further away, and, the brokers were underwriting these big rent growth and low expenses and, all these crazy things, it was basically taking away the whole value add.
Mm-hmm.
And so, but every once in a while we do find deals that are value add. And so, but they're further and further away and they're harder and harder to find. And, I'll bet you, there's not a week that goes by that I don't see one or two, but once you start getting into the numbers, there's always somebody that's going to outbid you anyway.
Mm-hmm.
And
so what do you do with the pushback for the broker? Because I don't want to seem like I'm annoying the broker or I guess insulting him, but some of these prices and these pro formas that you get, how do you approach them and make and keep that relationship? Because I get a lot of that. I get that questioned a lot. I'm putting such a low ball offer in. I just tell them, send your underwriting template over and let them see. What would your advice be to that?
Yeah, I think the brokers are in a weird position to, they're usually representing somebody. They've actually probably told them that it's going to be significantly higher, So basically, the broker to get the listing has said, hey, we think this can trade for $20 million. When you're making an offer at 17 or 18, let's say, he's just not going to have that conversation with that guy, the seller. And you know what I mean? And so what we've chosen to do is just say, listen, guys, we're probably out this cycle, and just be kind of palms up with them. And because back when we were offering, this is back in 06, 7, 8, 9, we would find a building. There might be 4 to 6 offers. Now there's 20 to 30, and usually probably out of the 20 offers, let's say 15 or 16 of them are very, very serious buyers. Whereas, when we first started, we might have been the only one, you know what I mean? So there's a lot more competition and the numbers are getting driven up, and there's a lot of people out there syndicating. And I just, I actually think the bloom is off the rose, generally for multifamily, for guys like us that are raising local capital and trying to maintain relationships through the cycle.
So how long do you think this cycle is going to last? I mean, how long, because we were talking about where all this money's coming from private equity, from REITs, and from all. Do you think it's going to last another 12 months, another 18 months? Or how do you see it correcting?
Well, that's kind of the magic question.
I know.
It's interesting. If you take a look at the supply and demand for apartments, there's a good case to continue to buy.
I know that. That's the crazy part.
It is the crazy part, but I've just never done well on a capital gain strategy of trying to buy and hope that it goes up. I believe that I think that we're going to start to see a lot of real pressure on affordable rent structures and coming down, because I think that, you look at markets, and we've been lucky enough to be in them, that we've had $300, $400, $500 a month of rent growth over 4 or 5 years on some of the properties, and even more. If you look at, but it's starting to peak. So San Francisco's peaked, Seattle's peaked. You start this. I think New York's peaked. You're starting to see some of those rents are starting to come down, and I think it's because there's a ceiling on what people can pay. But I think that what will change is if the new legislation starts adopting strategies to be able to let people buy homes again, then I think that you'll start to see a movement away from rentals, and that's when you'll start to see the cracks. But right now there just doesn't appear to be any.
But Ken, also, are you afraid of the demographics as far as the baby boomers renting and the millennials not being able to afford a down payment? Is that also what's happening with these cap rates lowering? Because it's such a much bigger the supply, the demand of this apartment is so great because these two demographics are not buying. They're the ones who are renting. So that's what's worrying me.
Though. It may be turning slowly, right?
Yeah, I agree with you. Yes, I think, yes, I do see that. I think there's a couple things going on. I don't think that the millennials are looking at their parents and going, "Oh my God, you guys made a lot of good decisions." You know what I mean? I just don't think that happened. They don't. I think what is the average? I think the average savings account is $2,500 or something, or 75% of the people in America have like $2,500 in savings or something. So, whatever our parents did or I did or whatever, they're not buying.
The parents.
Yeah. So, but I guess to answer your question, I think the millennials are a way different breed. I think they are. Well, I know they're living in smaller places. They want to be mobile. Yes. They look at renting as a choice. They're not doing the normal, hey, let's get married, let's have kids, let's move to the suburb deal. They're tied into tech like never before. So that, which is going on everywhere, Austin, Texas, or San Francisco, or New York, or Boston, or, areas of Florida. So, they're moving for jobs, and, they're also, they're in this, it's a lot different now. And so I think the mobility piece is a big factor that was never there, 20 years ago.
Yep. I'm glad you mentioned that, property management. What has changed for you over the course of the last 20 years in property management, especially technology? What have you seen in property management that's really been, wow, that's a huge change?
Well, there's just a lot, actually. It's interesting, because we're a builder. We actually took dining rooms completely out of our floor plans.
Wow.
As an example. And that was a pretty big one because it was like 120 square feet. Usually, you walk in, there's a slider with the patio and the light above it, gone. Because nobody sits at tables anymore, right? Mm-hmm. So our apartment designs have all changed, there's a lot more entrepreneurs. And so the connectability and the business centers and all those things are incredibly important today to be able to, operate and run even, multiple small little things, the package business, that's a huge one. The Amazon coming, and deliveries and all that kind of stuff, especially if you live in a 200 or 300 unit property. We're starting to see very sophisticated systems for that.
Have you got into those yet? I've seen those Amazon.
Yeah.
You got into those?
Yeah, we have down in Texas.
What's the cost on them? Do you know?
I'm not sure off the top of my head. The CEO of our management company has been working on all that, but it's changed a lot. You guys remember back in the day. When we were building properties, we'd have like a 4x6 room. There'd be 10 packages in it. Now there's hundreds every day. The UPS guys and the and the FedEx guys are delivering this stuff, and so there's a lot of people are working from home more a lot, and so and one of the things we're actually seeing we kind of like is a lot more community too. So because people are home, and so we're doing a lot more parties. We're blowing out our fitness centers, and what I mean is we're really we got virtual. Spin rooms and virtual yoga and all that kind of stuff.
That's really cool.
Yeah, those are all the kind of things, and we're retrofitting some of those in our older properties too.
Ken, I forgot to ask you. I should have asked you from the very beginning. What kind of assets do you like to focus on? Do you focus on A, B, C's? What's your favorite type of asset to focus on? So
I get asked this question a lot, and I think the more important question is the location. So. And then I'll answer your second question or your first question. So if there's a great location in town and there's a C property there, that would be something I would look at. Mm-hmm. But that would be the only time I would ever look at a C property. Okay. But if it's Main and Main and it's built in the 70s, let's say, it's always going to be a great location. Generally, what we did primarily this run was we bought late 80s and early 90s properties that were really well located and had room in the rents by putting in new flooring, new appliances, and doing basically remodeling every single unit. So That's basically how we created all the value this last cycle. And at the tail end of the cycle, what was happening was, let's call it our B properties that we were buying were maybe going up to a B plus after we renovated them. But then now all of a sudden they were they were trading for about the same price as we could build. And so that's when we started building. So, we can build for, let's say, $120,000 a door, and the B properties were trading for that. So all of a sudden, so that's when we naturally kind of moved into the A's. So we started with B's, and then we've kind of moved into the A's, and that's primarily what we're doing now is building a new product.
So you've gone from a 2-bed, 2-bath to 10,000 units. How have you been able to build your systems and build your teams and take it from that level to the level that you are at today?
Well, like a lot of people, I didn't know how to hire a CFO. I didn't know how to hire a controller. I didn't even know what to say to a bookkeeper, to be quite honest. And it just came with a lot of pain, I will tell you. But I did know how to hire property managers. And so I think that part of the business has always been running pretty well for me, because I can, I understand how to run properties. I understand how to hire property managers and how to manage them. The whole rest of the company, the marketing, the CFOs, the financial, all that stuff, that was just a lot of questions, a lot of mentors, and a lot of meetings, and a lot of reading, and a lot of, hiring the wrong person.
Trial and error, right?
Yeah, trial and error. And we just got named the top company to work for in Arizona.
Awesome.
And I think we were also ninth in the country. So through the National Apartment Association. So, we've got a good little company now, but I will tell you that if they would have stepped in here 10 years ago, they would not have thought that,
That's great. That's awesome. I have one more question. I just like to ask you, what's your best real estate investing tip for the listeners? I mean, getting into multifamily, what would you say to them?
I really believe that the market is more important than the money, than the property. I really do. I think the property is extremely important, but I think the market can save your butt. So if you buy in a market that's trending upward and you walk away from it, your property is gonna go up. And so I think that finding the right market and making sure that you're not stretching is probably the best thing, because it saved our butt a ton. But because we bought very well in markets that have gone down, and we've had to fund them. We've had to cash call. Actually, Ross and I have never cash called our investors, but we fed markets, and we bought well, but the market was trending down. But you can buy poorly, and the market trends up, and you'll still be fine. Oddly enough, so. It's what happens is everybody thinks it's them. Oh, I'm so smart. Look how well. Yeah. But honestly, the market will take your legs right out from under you.
What's more painful, funding a deal or hiring the wrong person?
Hiring the wrong person.
Dude, I'll punch you for months till you get them out of it.
I always say, hire slow and fire fast.
I like that.
Mm-hmm.
Yeah.
Like that.
This has been therapeutic for me because I'm banging my head against the wall saying, why can't we get a damn deal? And it's like, speaking to you, it's just making me feel, okay, you're not crazy. And we're in some networks with guys that are real aggressive right now, buying and throwing a ton of offers. We're hearing about, we're getting this deal under contract and that one. I'm like, what the hell's wrong with me? And I'm hoping I'm just staying disciplined and I'm not misreading things. And it's just nice hearing that from you as well. So.
I honestly, I think it's the best message you can give it's the best message you can give your students and your investors, because you guys are going to do the right thing. If a deal comes along, you're going to fund it and buy it. And
I want to so bad.
I know, so do I. And I'll tell you, we were always in the top three, let's say from 2005 to about 2012. And we were always invited to best and final. And then all the hot money came in, and we were always $1 million or $2 million off. And it's, same underwriting process, same criteria that we have internally for, to meet our investor needs and to produce cash flow. And I just believe that if you stick with that, you'll have a great following for the next cycle.
You've obviously built a tremendous business, started in property management. What is something that you do on a daily or weekly basis, a habit that makes you successful?
Honestly, for me, I spend my primary focus is on my family and my health, and then my business comes third. So, and it wasn't always that way. And so I think that, believe me, I think we all are looking for balance, and, it's talked about and thrown out about a lot, but I don't think a lot of people, take it really seriously and then take action around it. And so, while I've done all this, because it takes a toll of traveling around, and, for us, we're flying to, different states. I flew to Rome and back just so I didn't miss one of my son's wrestling matches. And, I mean, literally for the weekend. And, those are things that you have to do, in my opinion, because at the end of the day, when all the dust settles, your health and your family are the only thing that you have.
That's pretty cool, man. I love that. What about a book that you'd recommend to the listeners?
Well, one of the best books that first of all, I bring 150 employees in every year in December, and we do a book study. I buy a book for everybody, and we study it together for 2 days. One of the best books, there's a number of books, and I read a ton all the time, but one of the books that I love, and it's an older one now, I guess maybe 10 plus years old, is The Good to Great by Jim Collins. And the reason why I like that book is because he analyzes 6 companies that have gone from good to great. And he basically says this. He says that the enemy of great is good. So when you get good, you lose that fire in your belly to become great. And so, because I think everybody generally tries to be pretty good, but the difference between going from good to really, really, really good and to be great takes a lot of effort. And, while things are already running pretty well, sometimes it's easy to be complacent. And so that's one of my favorite books.
I agree with that, because when people start coasting, the next guy is right behind them, ready to take their share of the business.
Yeah.
So you got to keep evolving or you die. I really believe that.
Right. Yeah. They're always hungry. It's hard to stay hungry when, you're rolling financially and the company's doing well. And, sometimes it's hard for even me to come in and I take 2 months off. I actually just got back on Sunday. I recharged my batteries, and I wasn't in the office for 2 months, and just thinking about things I can do with the company and implement when I get back and make it better.
So we're talking about this whole, holistic approach. Don't get fat in your personal life, and don't get fat in your business, man. I think we can sum it up like that.
That's right.
And don't let your kids get fat. Make sure they're playing sports, right?
They are, yeah. That's exactly right.
All right, last question for you. What project are you excited about right now?
Well, we're doing a bunch of ground up construction, and I'm excited. Those are always really fun, right? Because it's all new, and and so we're into the lease ups and the marketings and the models and all that stuff. So, opening a new project, there's usually a lot of fanfare around it. So, those are the ones that I'm most excited about right now.
Very cool. Haven't been there yet. We're just buying and holding and praying we can buy something new. So I can't relate to that one, but that's great.
You guys will, for sure.
What's the best way for listeners to get a hold of you? And do you have any products out there where they can peel off some more advice from you or learn more about what you're doing?
Sure. Yeah. So, KenMcElroy.com, www.KenMcElroy.com. And MC Companies is the company name. All the proceeds to our books and my books all go to charity anyway. So any speaking or any books or anything like that all go to charity. So, but that's the best way to reach me or send an email or questions. I actually did a video series called Ken Flicks that we put out there for people because we were getting so many questions. And so I'd roll into the studio and, we do let's say a 3 or 5 minute video on a topic that came in on some really, really good question from somebody. And so we got a couple hundred of those videos up too. And so there's a little video library on, for people.
That's great. I mean, I guess in the show notes, I'm going to have the book review. I did a book review on one of Ken's books. So I want you all to read it. And I think if you're serious about getting into multifamily, I think his 3 books, there's a couple on property management and a couple and the other one on real estate investing. You need to buy those books. They're really inexpensive. I mean, for $30 or $40, you're basically going to have a framework on how to get into multifamily, how to choose a market, how to underwrite a deal, how to property manage, how to hire property management companies. I think you really need to spend the money up front. It's going to cost you nothing. I've had a great time. I could do this for 2 more hours talking about multifamily. I mean, this has been really an education for me.
Yeah.
Yeah, I know, but I'm just saying.
You guys need to go find some deals.
I don't want to get dad bod here. We're talking about staying healthy, okay? So I got to work out and do some more. But also, I would piggyback off that and say it's very apparent that Ken is the real deal. So check out Ken Flicks too, because you've been through the cycles and this is not a few years in and kind of thing. So Ken, really appreciate your time. Thank you so much.
Yeah, thank you guys. Best of luck to you. We'll talk to you soon.
Thanks. Take care.
We trust that you enjoy the Wheelbarrow Profits podcast. Visit jakeandgino.com, your one-stop shop for everything multifamily. See you next time when Jake and Gino share more of their investing secrets with you.